Politics is back as a danger for investors. Left-wing and right-wing populists are on the rise on both sides of the Atlantic, from Bernie Sanders and Donald Trump in the US, Jeremy Corbyn in Britain, Marine Le Pen in France, and new parties, of course, in Spain, Italy and Greece. This shift follows 2 decades in which politics stuck to the centre ground. Now events like the Eurozone crisis have put political risk back on the agenda for fund managers. More recently, geopolitical risks return too, with Russian troops in Ukraine and both Russia and the US intervening directly in Syria, while a refugee crisis tests the limits of cooperation between European leaders. There's fierce debate about the rights and wrongs of each of these issues, but how should investors who care more about the money than they do about the morality address the effects of government interference on their portfolio? Well, the natural place to turn for an answer is to emerging markets, where political risk never went away.
I mean, the nature of emerging markets is that they're as volatile politically as they are economically. I mean, one thing we would say about Brazil is that clearly, because at the centre of the political turmoil there are 2 economic issues: the future of one of the country's biggest companies and, above all, the fiscal path the country is on. But there you've got a clearly defined economic issue which you can address. I mean, the opposite would be something that we'd say like Russia last year, where people were very upset about the whole sanctions thing. But really it was very, very hard not to look primarily at oil. I mean, Colombia didn't invade Ukraine, and the Colombian peso performed, if anything, worse than the Russian ruble. So it was the oil prices, and in most cases politics is dominated by economics. So we always look for an economic issue, and if we don't see one, we would tend to tune out the politics.
Occasionally, of course, ignoring the politics would be a horrible mistake. Think back in the last century to the communist revolutions in Russia or China, where investors who did nothing lost everything. You don't have to look so far back in history either.
And I think a key example would be Ecuador a few years back. It was a country which defaulted on its external debt while it could still afford to pay it. And that's very unusual, and it's contrary to any economic-driven model of politics you're likely to have. So there will be times, as with any rule, where there are exceptions. But I think on average, if you always respond to turbulence in purely political terms by selling out of a market, I think you're going to lose money.
Politicians can equally easily destroy corporate value. After the 2011 earthquake and tsunami in Japan, German resistance to nuclear power was revived, even though Germany itself faces no risk of either earthquake or deadly waves. Berlin ordered half its reactors to shut immediately, with the rest closing in the next few years, and a big switch to renewable energy, something which trashed the shares of German utilities, which have since halved. Forecasting natural disasters is next to impossible. Should investors ignore the political risks which follow as well?
I think political risk is a narrative. It depends how it develops over time. The event itself, you're going to get make it a knee-jerk response. Think about 9/11. But it's the narrative that comes after that. Do monetary conditions get eased? Does the currency sell off? Does it fundamentally change the corporate model? How big a change in markets comes about immediately, and is that an opportunity rather than a threat? Well, if you look at this chart, which is a Google word count, you'll see that attention immediately is drawn to the event. By definition, the markets probably haven't discounted it. And then pretty shortly afterwards, it drops back again. And markets tend to respond in that way. So I think it's a question not of being obsessed by the event, but more thinking through the consequences that might evolve down the line and assessing whether or not there's an opportunity or a threat for investment.
So how can you decide whether any particular political event is a reason to buy or sell? Well, you look at the risk premium. In other words, the compensation that's priced in for the risks that you're running.
Well, I think if you get an extreme risk premium, an extreme sell-off, then it's usually the question of have things moved too far? That tends to be the way that people are trained to think. If it's something that is in the newspapers for a few days, and you can see that these events come and go in the newspapers, then it probably doesn't have much of an effect, and you should ignore it.
Sometimes political noise is a warning of seismic shifts in the financial landscape. Think September the 11th. But most of the time it signifies little. But even when it does, it's just too hard to assess. And investors, therefore, should just ignore it. James Mackintosh, Financial Times, London.